Okay, yeah, indeed, we have seen good performance from equity markets after a weak 2022. And on the macroeconomic side, I would say we are at the beginning of some acceleration. So we have lived through those last couple of years with PMIs typically below 50, pointing towards contraction, and economic growth that was below what we think is the potential overall. And for 2026, we would expect some acceleration of the economic cycle. You're right, the stock market cycle was already going ahead earlier. It was driven by a pretty narrow part of the economy, namely by the IT sector, while many other parts on the industrial side, on the consumer side and so on, were actually lagging that development. And we think also these other parts can now join the party and benefit from that. Yeah, there have been some that have been already well established over a few years now. Again, technology, which is benefiting very much from the AI revolution that we are seeing, but has been also joined more recently by some other interesting trends that we have seen in the market. For instance, we saw gold performing extremely well during last year, moving away from just being inflation protection. So typically people buy gold for inflation protection, but inflation is 3% in the US, 2% in Europe, so gold should have gone up 3% or 2% in order to compensate you for the inflation. What we have seen was like a doubling of the gold price, and that is much more than just inflation protection. So there's something else going on here. There's a lot of speculation in that space, for instance. That was a trend over the last 12 months, but because it lost its original purpose of inflation protection, might see some stronger volatility. So maybe not so sustainable going forward. Some other trends, like the AI trend, we still see confirmation from the companies that this is something that goes on for longer. And a shorter term trend that we have seen also in that same space was the rush for DRAM, for memory chips, that led to some fantastic performance of a couple of companies and an unusual price rise for these DRAM chips. Here we see also some longer lasting situation despite the sharp increases in prices, because the supply demand situation is still not going to be solved even at the end of this year and maybe towards the end of 2027. But the usual 6-month cycle that you have in DRAM, that you have an immediate supply reaction, that is not going to be possible this time. So it's something that should be more sustainable going forward. So the US is of course at the core of this whole AI revolution on the hardware side. On the software side, they are hosting the hyperscaler companies. There's none of these companies in Europe. Europe has an interesting company with ASML and ASM International that is supplying the machines for the chip making. So Europe has some exposure, but the big names continue to be, of course, in the US here. TSMC is another important global player on the chip making side from Taiwan, and that is pretty much that every region has some exposure, but the US is still the kind of dominant exposure when it comes to this AI and technology trend. Together with what I said earlier about the economy likely to accelerate, with the Federal Reserve still likely to cut a couple of rates in the US, with US inflation still at potential of coming down further. I said we are at 3% in the US, could go down to 2.5%. Europe is already below 2%. There's not so much more to come from my point of view. So the US has really the tailwind of fiscal spending, technology, and also monetary help from the Federal Reserve, and should that why be a preferred market. Europe at an interesting point of Germany re-accelerating. Of course, lots of expectations already there for that, and there's some risk that this comes later, this comes smaller, and not so much help on the fiscal side, on the monetary side, I would say for Europe. And then emerging markets depends a bit on also what the US currency is going to do going forward. Last year we have seen some devaluation that was helpful for emerging markets. For this year, maybe less to do on that front, and we are coming back to more company-specific stories there, like a TSMC again in Taiwan, which should continue to benefit from the chip expenditures. So two different strategies that we are running. We're looking at companies for the same way, looking at cash flow companies are generating compared to the investments they are making, and taking it like when you look at a bond, right? You have to make an investment, you have to buy the bond, can cost you 99, can cost you 101, can cost you 100. If you get a coupon of 6, of 8, so on, mix the investment differently attractive. And that's how we look at companies, what kind of investments they have to do, and what does it cost to build the factory, to put the machines there, but also short-term capital needs for working capital that you have there in comparison to the cash flow that you can generate from that. So pretty simple concept actually, but we find companies are going through a life cycle there. So they start with high growth and low levels of cash flow to investment where they still have to invest a lot into the assets. Then they are moving into a situation where it's more comfortable, they're covering their costs, they're having good levels of CFRI. Typically that attracts competition, and then these returns are coming down again. And then finally you end up with companies that are more in the value space, so not a lot of growth anymore, not a lot of cash generation. Companies are trying to reinvent themselves and start to get into a next growth cycle. And we are finding interesting investments along these three alpha opportunities. Growth companies, companies that are already very profitable and doing well, as well as value stocks, turnaround stocks. That would be our global equity strategy. And the 30 global leaders strategy is really focusing only on these well-established large companies that have already a good product, a big brand, a big name, quality names you would call them. And that has worked for many, many years quite well. Was struggling more over the last couple of years, has now also been traded at lower valuations. So some people are considering maybe quality could have a better turnaround situation again for them. So two different approaches. The one that is really across the whole market and has been doing well over the last couple of years, and the other one which has a long-term good history but has suffered over the last couple of years, may see some improvement ahead. So the structural opportunity is for us really this kind of quality profitable companies. The cyclical opportunities, and as I said at the very beginning, we are positive on the cycle, are currently on the growth companies as well as on the value companies. So thinking of European banks, for instance, which have suffered a long time from negative interest rates, now become very, very profitable, and the market doesn't really fully believe this. And as these banks can continue to grow their earnings, which is our analysis, they should continue to also do well as an investment. So to invest into growth elements and into value elements alongside the quality right now and make more space for those two is really how we are positioned on the global equity side. Yeah. So the earnings growth comes mostly from, well, the growth companies, because it's often a risky investment because growth is overestimated or underestimated. If it's overestimated, you get earnings downgrades. Stocks are typically trading on elevated multiples, so they have sharp downward reactions if something goes wrong. We think with a positive environment, there's a good chance that these stocks are surprising rather on the positive side, and we can get the growth from that growth part of the market with also the macroeconomic support. And then the other growth that we are still seeing that I mentioned earlier is on the value side, where not many people believe that banks can still grow their earnings from here, because we have seen this big improvement over the last couple of years as we have positive interest rates again. But we still think the loan losses are very much under control. Banks are not too optimistic when it comes to the revenue side, but quite a few banks are coming out with cost targets that are actually absolute declines in costs over the next couple of years. And we have good experience with management delivering on these kind of cost targets, while revenues is always also market dependent, interest rate dependent, macro dependent. It's more uncertain to make the forecasting there, but costs is something that management can address more directly. So self-help stories there can still capture growth and earnings. And then on the quality side, that was again the picture that was not doing so well the last few years, and where we are also need to be a bit careful and look at company by company what the outlook is there, and be a bit more selective in terms of growth that can be contributed there. So that's what we have seen, actually, the portfolio behaving. Independent of the fund overall performance, we have seen that in the last 10 years, for instance, there was always earnings growth with our companies. If we look at the market had 4 years in those 10 years where earnings growth was negative. It was 2015, where we had an industrial recession after the oil price collapsed. It was 2020, of course, with COVID, where the earnings were negative for the overall market. I mean, airlines, hotels were having a very tough time. Also banks, still with negative interest rates, were not doing very well during that time. So earnings growth was going backwards and earnings were falling, while for our selection of companies, it was growing. The companies actually had business models that were fitting quite well to the COVID situation, and they had earnings growth even in 2020 2020. And then again in 2023, when the market had almost no earnings growth, our companies were growing again nicely. During most of these 10 years, also the strategy performed quite well. As I said, over the last couple of years, it has been more weak in terms of performance, not holding up with a sharply rising market, but the underlying earnings growth that we have seen has been always there. So here we have seen also for many years a trend that people liked this quality approach. They were seeing that these companies delivering whatever the environment, whether there's a recession, whether there's actually a good environment, these companies would grow their earnings. And in good times, we were holding up in line with the rising market. And in bad times, we were holding up better because we had the quality companies and we were not so much exposed to the riskier parts of the market. And that led in 2020, 2021 to really a big rise in the valuation. So for the overall portfolio that was normally trading around 20, 23 times earnings, we were seeing an average of 31 times earnings. So you had some stocks that were trading at 45, 50 times earnings, some stocks of course still in the 20s, but the average was as big as we have never seen before. And this has reversed since 2021. Over the last couple of years, this has come down again, and we are back to normal valuations, 23 times for the overall portfolio. It's still a slight premium to the market, which is more around 20 times now, but it is much smaller premium than what we have seen over the last 10 years. So I would say from a valuation point of view, yes, there's a premium, but the premium has been much bigger in the past, and now we are at a more palatable kind of level of valuation here. So if you take this view of the valuations back to kind of levels we haven't seen in the last 10 years and are convinced that these companies will continue to have earnings growth again this year better than the overall market, and that's also our analysis, then this could be the point where this earlier obstacle of higher valuation that needed to normalize over time is no longer there, and we could see some turnaround on these quality names. Also, the market is quite open for rotations, as I hinted to earlier, and things that have gone up a lot, like gold, like parts of the IT sector that had very good performance. If the market feels a bit in a rotational mood, like what we have seen over the last couple of days, for instance, then you might see some rotation into lagging parts of the market, and quality clearly has been a lagging part of the market, and that could be supportive here. If you're not convinced about all this, then it's rather the other strategy, global equity, where we invest really along the life cycle, where we have been doing well over the last couple of years, and then you have a continuation of that kind of trend. I have quite a few clients who run the two strategies parallel to each other, and have actually had also in former times periods where the one was doing better, the other was doing not so well. And diversification is a word that you're hearing a lot when it comes to investing right now. And that is something that then these kind of clients would play to say, okay, we have some allocation into this quality and then some allocation into really across the whole market. And with that, actually, we might not always have the same results, but in the portfolio effect, we have some benefit from that, a bit more stable returns.